Ma'am, please start.
A very good afternoon, everyone. Rather, a very good evening, and welcome to day three. That is the third day's session, which is going to happen in the second half. First of all, my apologies, my sincere apologies that we have started it a bit late because due to some technical glitch that was happening from the faculty side, and he was not able to enter. So there has been certain issues with his IT system or something. So sorry for that. Sorry for the inconvenience caused. But without wasting any more time, we are going to start the online live coaching classes for the CMA students, which is going on for syllabus 22 for all the three levels. And this is the second session of the day. That is the session which is supposed to happen from 3 p.m. to 5 p.m. And this is the paper 13 session on corporate and economic laws. So we have with us Professor Subroto Kumar Ray, Professor Law and Management, Makot. Good afternoon, sir. A very good afternoon. And just to introduce him, C.H. Subroto Kumar Ray holds a postgraduate degree in law, LLM, diploma in industrial relations and personal management, advanced diploma in alternate dispute resolution from Nalsar, Hyderabad, besides being a FCS. He is presently a professor in the management and business law in Maulana Abul Kalam Azad University of the Technology, Makot, State University, and he has been teaching there for MBA and LLM courses. He's having around 38 years of experience in the corporate sector, and he's also the former general manager and company secretary of the Government of India listed company based at Kolkata. He really doesn't need a very long introduction, but he has been contributing to various articles and journals throughout his career, and he has been a visiting faculty in many B schools, which includes IIM Kolkata, Shillong IIFT, and he's also an empaneled arbitrator of the Indian Council of Arbitration. He was elected member of the Regional Council Eastern of the Institute of Company Secretaries of India from the period of 2004 to 2010 and the chairman in the year 2007. So, sir, all the students are eagerly waiting to hear from you, and it's all yours now. Over to you.
Yeah. Okay. Thanks. Thanks, Madhumita. So, welcome, students. I'll just we'll start. See, this is a refresher course type of a thing where we'll be talking on some important issues. Not the whole thing can be taken. So, and I'll also take your problems which you are facing in studies of this particular paper, but we'll be taking a few selected chapters and we'll discussing on that. You can appreciate that everything cannot be covered here, and therefore we'll talk about, to start with, we'll talk about the basic company law, which all of you are aware of. And can you see the PPT, student? Is the PPT available to you?
No, sir. কোটা পিপিটি আছে এখানে?
Now, is it available to you now?
Yes, sir.
Okay. So, Sanjeev, how many students are there? Sanjeev, are you there in the class?
40, sir.
40, very good. So, they are all India, they are West, Pan India, I think.
Yes, sir.
Yeah. So, to start with, I'll just tell you the various types of companies which you must also be knowing by now. See, all of you are aware of holding and subsidiary company. The holding company is those company holding more than 50% in a company, in some other company. A is holding 50% in B, so B becomes the subsidiary company and A becomes the holding company. Now, there are no limits to holding. So there are some of the companies are very 14, 15 companies as subsidiary companies. And in the meantime, there's a new definition of associate company where it says that the other company should have substantial influence on the other company. If A is having substantial influence on B, A will be called as the influencing company and B will be called as associate company. So that definition is there in the Companies Act. But here I'd like to tell you one thing, that holding can be through management control also. When you talk of management control, it says that suppose B company, A company is holding only 40% of B company. But in the Articles of Association of B Limited, it is mentioned that majority of the directors of B Limited shall be appointed and removed by A Limited. That is the other company. So here the B company is giving the management control to A company, and therefore A company is becoming the holding company of B. This is called holding and subsidiary through management control. This is called holding and subsidiary through management control. Now there is some other companies also. OPC, all of you know, one person company came with the Companies Act 56, 2013. So one person can be a owner of the company, director of the company. There is, several other, provisions which apply to one-man company. We'll talk about it little later. The bigger difference is the private limited company and the public limited company. And I presume that most of you know the difference. The most important difference is, but the private company cannot invite finance from the public. Therefore, you must have seen that all the companies who are making public issue, they were incorporated sometime as a private company, they convert into public company, then only they can make a public issue. And the other most important restriction in private company is restriction in transfer of shares. In private company where we have got maximum 200 shares, excluding employees, the share transfer takes place within a very close circle, maybe within the relative or within the same fraternity. So what is this basically? The restriction is here that whenever in a private company or in a joint venture company, let us presume, if somebody wants to sell the shares, he will offer it to the other shareholders. If the other shareholder refuses, that he can sell it to third parties. So this is basically called right to first refusal. If you have any notebook in front of you, you can write down right to first refusal. So right to first refusal is a very common term in a joint venture contract. And when a joint venture becomes a company, this comes in the Articles of Association of the company as restriction to transfer of shares. So this is the biggest difference between a public limited company and a private limited company, apart from number of members of the company. Section 8 company, all of you know, for charitable purpose. Earlier it was Section 25 company. So once you register a Section 8 company, there are a lot of approvals you have to take. The law applies to you. There are certain exemptions of the Section 8 company, but otherwise the company law applies to you. You need not write the word limited after the name, and the surplus which is generated in the company will not be distributed to the shareholders of the company. This is the basic provision of Section 8 company, non-profit. We have got another type of company, government company, that is where the central government or the state government or the central government, state government jointly will be having 51% shares, equity shares, so that they can control the company. This becomes a government company. Now, supposing that a government company is also having a subsidiary, that subsidiary also will be called as government company. So this is so far the government company is concerned. We've got nearly 1700 and odd government companies in India. Out of that, 258 are central government companies and balance are state government companies. Now, government company have some exemptions also, but the whole Companies Act applies to government company as well. But at the same time, government company has certain obligation also. Now, there are two major obligations which I'll talk right now. One is in government company, there is double audit. Double audit means there will be first audit by the statutory auditors, and the second audit, which is called supplementary audit, is done by CAG, Comptroller and Auditor General of India. So they have got a principal director in various regions, eastern region, western region, southern region. So the principal director will come and his team will audit after the audit is made by the statutory auditors. This is called supplementary audit, which applies to government companies. And the second obligation is the annual accounts of the government companies are to be placed in the parliament. So what happens is in the winter session, which starts in November, all government companies are supposed to place their final accounts in the parliament in the winter session, because by 30th November the AGM is over. So the annual reports are printed and those annual reports are placed in the parliament, and any member of the parliament, if they want, they can raise a question on that. Next we have guarantee company. Guarantee company is something like LLP. Conceptually, it says that suppose 10 people form a company, everybody pays 1 lakh rupees as share capital and the share capital is 10 lakhs. But they also guarantee that in case of closing down of the company and winding up, if there is any third party liability, they will pay 1 lakh more. So they are paying 1 lakh at the capital now, and they will be paying another 1 lakh in case of third party liability. So they are taking a guarantee of another 1 lakh. This is the concept of guarantee company. Surprisingly, when you say company, it basically means company limited. That is, the liability of the shareholder is limited to the extent of the shares he has taken or he has agreed to take. So this is the basic concept of a joint stock company. But if shareholders feel, they can go for an unlimited company also, where the shareholders themselves decide and declare that their liability can be unlimited. Unlimited means even their personal assets and belongings can be taken in order to satisfy third party liability. So those companies are called unlimited companies. So you got Indian companies, foreign company. Indian companies are very simple. Those registered in India are called Indian companies, and those companies which are registered out of India but doing business in India. Doing business in India, either directly or indirectly, will be called as foreign company. After that, we got sectoral companies. Sectoral companies means that there are certain sectors like banking is a sector, insurance is a sector, telecom is a sector. Now what happens here is electricity is a sector. That there are two laws. Take the case of Axis Bank. The whole company law applies to Axis Bank. At the same time, the provisions of the banking regulation that also applies to Axis Bank. Or take the case of insurance company, any insurance company. Take the case of LIC. The whole company that applies to LIC at the same time, the Insurance Act also applies to LIC. These are called sectoral companies, where they belong to a particular sector and there is a regulator of that particular sector. So that particular sector regulator also regulates the company. And lastly, we got investment company, where more than 15% of the business or the income comes from the business of investment in other companies. So these are the basic types of companies which you have. And if you have any questions, anybody, I don't know how to make the question. You can type the question if you want. Okay. So yeah, I think we can proceed now. And as I've already told, so I'm not repeating here. And now the most important of thing here will come as that how the person becomes a member of a company. I'm not talking about formation of company because that is very basic and I presume that all of you know that. So, very tricky question here, the membership. When a person becomes member of a company by allotment, that is, shares are created and allotted to the company. This is basically called primary market. In primary market, the companies allot shares to their applicants who want the shares. They give shares to those companies, those employees, those persons. It becomes the allotment. So this is called primary market. Allotment is the situation where the shares are created or the securities are created. And the most common method of acquiring a share is by purchase. To purchase from the stock market or from any other person. This is called membership by transfer. Somebody is transferring his shares to you, so you become the member of the company. Member and shareholder is same, but there is a little bit of difference. Sometimes it so happens that you buy the shareholder, you become the shareholder of the company. But the name of the seller or the transferor is still existing in the books of accounts of the company. Unless or until you give the documents to them. And now, of course, it is done through electronic mode. But if you talk of physical mode, unless and until you deposit your transfer deed and the share certificate, the transferor names will come, your name will not come. So you don't become member till your name is appearing in the register of members. So there is a thin line difference between member and a shareholder. And transfer is the most common method of becoming a member of a company. The third situation is transmission, act of God or act of law. Act of God means it is inheritance. Suddenly somebody dies and you are the nominee, so the shares will come in your name. And by law, I mean basically amalgamation or merger. Just imagine the people who will be getting the shares of HDFC. They never applied for shares of HDFC. They were the shareholders of HDFC Bank. So the shareholders of HDFC will now get shares of HDFC Bank, which they never applied for. So this is called act of law. This is how a person becomes member of a company. And the same way a person, ceases to be a member, his allotment is cancelled. Number one, his allotment is cancelled. Shares are forfeited. He was a shareholder, but shares are forfeited. He is no more a shareholder. He sells the shares, again he is no more a shareholder. By amalgamation, merger, spin-off, whatever it is, demerger, he is no more a shareholder. And lastly, now we have got the system of buyback. In case of buyback also, once the company buys your shares, the shares are cancelled and the shareholder is no more a shareholder. So these are the ways which a person ceases to be a shareholder. Okay, how do I get your queries or reaction or your questions? Are the students entitled to talk? Yeah, am I audible?
Yes, sir.
Okay. And is there any system of getting the feedback of the student? Can students see my PPTs? Can any student
Yes, sir.
confirm?
Yes, sir. Yes, sir.
Okay. So, this particular PPT talks about, in very short, how the company is managed. Now, there is a word saying that professional management, you people must be aware of that professional management versus ownership management. So, we live in a country where 99% of the companies are managed by the owners. They've got nearly 13 lakh companies registered in India, and except a few, companies are managed by the owners or by the majority shareholders. Even most of the popular companies, the MD or the chairman, full-time chairman, they are the owners of the company. But still, that doesn't matter. There are some very good companies in India managed by the owners. The biggest company is Reliance Industry, managed by the owners. Wipro, managed by the owners. So there's nothing wrong in that. In fact, family managed business has shown a very positive growth rate. So this is about the management. And here we talk of management means the people who are directors of the company. All of you must be aware that Companies Act do not talk of management below the board level. Companies law is confined to management within the board level. Below the board level, you can have any name. He can be officer, he can be assistant, he can be vice president. You can have any name. The point is whether he is a director or not. If he is not a director, company law has nothing to bother about that person. So this is the basic difference between professional management and ownership management and the concept of. Now, this again, all of you should be aware, it's only a repetition doctrine of Walter Weyers. That means a company is for a particular person, particular purpose, and there are certain particular persons who are given certain authority. They are board of directors. But the company is formed by the shareholders. Shareholders decide what the company is supposed to do, and that is there in the object clause. If there is something which is found which is not within the object clause, it will be called ultra vires. Ultra vires means beyond authority of the company. The company cannot do anything for which it is formed. The directors do not have any authority to do something which is not mentioned in the object clause of the company. If they do it, this will be their personal liability. The next basic concept is indoor management. It says that an outside is not bound to know. There is something called doctrine of privacy. It's called PVT of management mentioned down below. It says that companies will have adequate right to privacy. I'm a company. I should have privacy. So right to privacy, unless they are bound to disclose as per certain laws, as per certain regulations, or for the requirement of some authority, statutory authority, they have to disclose something. Otherwise, they can have privacy in management of the company. But that privacy should be, within certain limit. If you do something wrong, what will happen? This is called lifting of corporate veil. That means any public authority, government authority can enter into your company. They will not give you any privacy in that case. If you do something wrong, they will go deep into your internal affairs of the company to investigate what has happened. So this is called lifting of the corporate veil, normally done by government authorities. SFIO, if you have heard of, Senior Fraud Investing Office, CBI, CID, police, revenue intelligence, these are the authorities who can lift your corporate veil. Otherwise, you have got doctrine of indoor management, that is when the outside is not bound how you are managing the company. Outside will assume that everything is fine in the company. Any outsider will assume, supposing you appoint somebody and the letter is written by the personal officer, appointment letter by the personal officer or manager HR, the outsider is not going to ask whether the manager HR is authorized to issue the letter or not. He will presume that yes, the manager HR is authorized to issue the letter. So this is called doctrine of indoor management. But this is a doctrine which is totally opposite to the doctrine of indoor management, and that is called doctrine of constructive notice. In doctrine of constructive notice, it says that outsiders shall be deemed to have knowledge of the facts. That means, supposing there is an outsider and he has got access to certain information. He has got certain access to information which may be there in the website, or which may be there in the public domain, or which may be there in any booklet or in a brochure, or which the other person is supposed to know by the fact that he is associated with the company. He cannot deny that he does not have knowledge of that particular information. That is what is called as doctrine of constructive notice. If you go to the court of law, the court will say you are the person you are supposed to know this particular information. The court will believe that you had constructive notice of the particular information. This is called doctrine of constructive notice. So these are some of the basic concepts of management, and thereafter we'll shift to the structure of the management, structure of company management. See, this is how from the top to down below. Down below means up to board level, not below the board. The levels are mentioned here. So, as all of you know, the company belongs to the shareholder. The shareholders are the owners of the company, and therefore, owners are on the top. Owners are on the top. What are the powers of owners? Owners have all the powers, not delegated to the board of directors. At the same time, there are certain powers which are reserved for the shareholders. Section 180 of the Companies Act says that board can manage companies. When you talk about the powers of the company, section 179 and 190 has to be referred to. So, one section says that yes, board has substantial power to manage the company, but at the same time, the law says there are certain powers which cannot be done by the board unless and until they are specifically authorized. Unless and until they are specifically authorized, that means that unless that authority is there, shareholders are not, directors are not supposed to do that. So this is on the top we have got shareholders. The next level is board of directors. The board of directors, all powers of decision making about the company unless reserved for the shareholder, told you. Now we come to individual. Board is a collective of people, collection of the people. Individually they are called directors, collectively they are called board of directors or board. So the single person, the chairman, is the top person in the board. He can be executive, that means he is full time in the company. Like there are a lot of companies in India where the chairman is an executive. He's not CMD. I'm not talking of CMD. He's only chairman. Company like LIC, State Bank, Steel Authority of India. Now Wipro. Wipro also having a chairman who is an executive. That means he sits in the office every day. He gets salary from the company. So they are called executive chairman. But normally, chairman of the companies are non-executive. That means they come to the meeting only and preside over the meeting. So they come to board meeting and they come to general meetings. They may also come to board committee meeting if they are chairman of that committee. So this is so far the role of the chairman is concerned. Now we come to another designation which is very common in our Indian corporate, that is called CMD. This is the person who holds both the portfolio, is the chairman as well as he is the CMD of the company, chairman and managing director of the company. So what is his role? He chairs the meeting of the board. He also chairs the meeting of shareholders. At the same time, in other days, he is fulfilling his obligation and duties as a managing director. What is the role of managing director? The managing director has the substantial powers of management, and he basically looks after day-to-day affairs of the company as chief executive officer of the company. By default, unless specified otherwise, the managing director is the chief executive officer of any company. But suppose you've got a chairman in the company who is full time, obviously chairman will be the CEO. In that case, even when you have a managing director who is full time, he will not be CEO. The chairman will be CEO because he is full time. But let me tell you here that CEO is a word which is not there in the Companies Act. So since it is not there in the Act, you can have more CEOs also. You can have CEOs for each vertical, each department. CEO hotel business, CEO FMCG business. That is possible. Okay, because CEO is not a legal designation. Now, after the managing director, there is somebody called whole time director. What is his role? He is a director who is full time. That means full time director getting salary from the company and designated as director of the company. Must have heard in some of the company will get a letter. Somebody is signed and he writes director, only director. They are called whole time director. This is very common in family business. So what happens in family business is that in many occasions I've seen that the father is the chairman, the elder brother, this traditional system. The elder brother is the vice chairman, and the younger brother may be the managing director. This was there in Reliance, biggest company in India. Dhirubhai Ambani was chairman, Mukesh Ambani was vice chairman and managing director, and Anil Ambani was managing director, only managing director. But you find in many companies, there is one person who is chairman, maybe the father is chairman, and all others will be called as directors. So this is a very common method of management. Now, when you talk of whole-time, whole-time director, they can be functional directors also. Functional directors means some function is attached to him. One director is asked to look after finance. We'll call him director finance. One director is asked to look after commercial. We'll call him director commercial. So this is the concept of company management. Now moving ahead, this is I told you the structure of the management. Now you need a constitution of the board, very important. Constitution of the board or composition of the board. So here you must be knowing that in case of private company, the minimum directors should be 2 and maximum 15. In case of public limited company, minimum 3 and maximum 15. Again, the same thing. And you can increase the number of directors by passing a special resolution. That means 75% of the shareholders decide that we should have more than 15 directors. In that case, we can have more than 15 directors in a company. So this is the basic composition. Now, when you talk of 15 directors or 10 directors or 7 directors, who are these directors? Who are these directors and what are the types of the directors? What are independent director, non-functional director, functional director? What are these? In order to have a ideal composition, you need to know the various types of directors, and that is what I am just going to tell you now. So here we have got director types. First directors, they are appointing authorities, the articles of association. The moment to incorporate the company, you have to declare who are the directors of the company. Their name can be there in the articles of association. Or you have to give a separate letter to the ROC declaring that these are our first directors. And what is the situation of appointment at the time of registration? What is the tenure of office? How long they will continue as a director? Up to first annual general. Now see the logic here. It says that when the company is new, it may not be possible for the company to decide on the directors. Because there will be a lot of investment in the initial years. A lot of people may be interested to invest. So law is made in such a way that after first AGM, up to first AGM, and first AGM can be held within 18 months. So up to 18 months, the company may be various funds may be coming from various sources. And whoever is giving the fund would like to become director of the company. So a very logical provision made here. Then the first AGM, all the directors will vacate their office. And the purpose is that adequate liberty should be given to the shareholders to decide the board of directors thereafter. Sanjeev, is there any mechanism of interpretation from the student interaction? Sanjeev, can you hear me? Okay, so now we'll be talking about the various types of directors that I was just telling. So normal directors are those considered to be normal directors, means they are appointed in shareholders meeting. This is the most common method of appointment of directors. Shareholders are appointed in general meeting through normal voting procedure, and you know the retiring director, non-retiring director. As I told you, maximum 1/3 can be non-rotational. That means they will not rotate. They will not be liable to retire on the basis of rotation. Maximum should be 1/3, and minimum 2/3 shall be rotating directors. Suppose there are 12 directors in a company. Minimum 2/3 means 8 directors have to be rotational directors, and 4 directors can be non-rotational. But there is no bar that all the directors are rotational. All the directors can be rotational, but all the directors cannot be non-rotational. So again, taking the same example, there are 12 directors and 8 directors are rotational directors. Out of these 8 directors, 1/3 shall retire in every AGM. In every AGM. That means what? That in every AGM, 3 directors, that is rounded off to nearest figure, that is 3 directors will retire in every annual general meeting. Now, who will be these 3 directors? These 3 directors will be the oldest director. That means they have been appointed first out of all the directors existing. So they will be retiring in the ensuing annual general meeting, but they are eligible for reappointment. They are eligible for reappointment. So if they are eligible for reappointment, their resolution for appointment will automatically come. He need not have to do anything. The director need not have to do anything. The company secretary will find out whether he is suffering from any disqualification, or he has said he doesn't want to continue as a director. or there is some bar on which he cannot be appointed. Otherwise, his appointment will automatically come in the notice of the annual general meeting. Resolution for his reappointment. But some shareholders can oppose his appointment. They can oppose his appointment, which is possible. For that, the shareholder has to give a special notice. That is called resolution requiring special notice. So this is how the normal directors are appointed. Now a question is, let us assume a situation where somebody is appointed for the first time. That is possible. So when the director is appointed for the first time, the procedure is either the director himself or any shareholder who proposes his name along with a earnest money of 1 lakh. And if the director doesn't get 25% of voting, then this money shall be forfeited. If the director gets more than 25% of voting, this money will be refunded. And if the director gets more than 50%, that is elected as a director, again the money shall be refunded to him. So this is how a new person can be appointed as director in a company. I presume you could understand this. Now see what happens is that there can be a situation where the company cannot wait for the annual general meeting to appoint a director. Supposing this year's annual general meeting is over in the month of August, and in the month of September, the company feels that some person very important in the industry, he should be appointed as a director. Let's take a case of a steel plant, mediocre steel plant, and their AGM is over in the month of August, and in the month of September, a very senior person of another steel plant, very reputed steel plant, he retires, and this company is interested to take him in the board because he is having wide experience in steel industry. So they cannot wait for the next AGM, which will occur next year in the month of August. So the law has made a provision that the board of directors can appoint this person as additional director. His rights and liability will be same, but he will be called as additional director. Board will appoint, and this person will continue up to ensuing AGM, that is next AGM. Up to next AGM, this person shall be a director. So what will happen in next AGM? In next AGM, he can be regularized. That means somebody will give a notice for his appointment, and his appointment shall be voted. If he is voted in, fine. If he is voted out, he will go. So this is how board has the power to appoint additional director. The next type of directors which the board of directors can appoint, called alternate director. This is the situation the original director is out of India for more than 3 months. The original director is out of India for more than 3 months. The board of directors, it is not that that person can nominate somebody. He cannot nominate that I am going as a director, this person will be director in my place. Not like that. So first the board of directors will decide that Mr. X has gone out of India. Is it necessary that we have a director in his place? If yes, the board of directors feel yes, there should be somebody in his place as an alternate director. So who will be that person? That will be decided by the board of directors. So alternate director will act as a director till the original director comes back to India. And once it comes back, the alternate director ceases to be a director. The original director will take the place. So this is about alternate director. There were other kind of directors appointed by the central government. This is a situation where due to operation and mismanagement, the central government interferes in the management of the company, and after interpretation, the central government feels that some person should be appointed as a director, then the central government will appoint that person as a director. All of you must be knowing the episode of Sattam. The Sattam fiasco happened. The central government interfered, and he cancelled the board, made the board ineffective, and he appointed new directors in the board. So this is the directors appointed by the central government. Now, central government also appoint director in the normal course, that is by nomination. Why nomination? Because there are many companies the central government is the majority holder or maybe minority holder. As per the terms of investment, the central government may nominate somebody as director in the company. Like in most of the government of India company, central government has nominated the senior officials of their ministry to be directors in the company under its control. Now there can be nominated director by banks and financial institutions because they are investing a chunk, maybe 5%, 10% in a company, or they are giving a huge amount as loan. If they are giving a huge amount as a loan, they will insist that one of their nominees shall be director. The idea is that they will also participate in the management, and whatever is happening in the board, they will be able to know, because once you are a director of the company, you will be sitting in the board of directors meeting. Obviously, you will be having a lot of information with you over the company. So this is nominated by financial institute or government. So they are called nominee directors. You must be knowing this word. They are called nominee directors. Let's go to some other types of directors also. A very important here is independent director, compulsory for all listed company and some unlisted company where the paid up capital is 10 crores, turnover 100 crores, and outstanding loan is 50 crores. So if this situation happens, you are supposed to appoint independent director. So just see that this provision, some people have a idea that this is only applicable in case of listed company, but that's not correct. It also applies for unlisted company with certain threshold of turnover, investment, and outstanding loan. So what is the tenure of office? 5 years at a time. Okay, and they can be reappointed with special resolution. Now see the fun. So they can be appointed, but 75 of the shareholders should agree to their appointment for the second term of 5 years. A very interesting provision which came in 2013, that the small shareholders should be protected. Small shareholders should be protected. Now, small holders have been defined by those shareholders who are holding up to face value of 20,000. Those who are holding the face value of 20,000, they will be called small shareholders. And it says the small shareholders can meet and they can elect a person, and that elected person shall be nominated to be director of that company. And that person shall be director for 3 years. He is considered to be an independent director, and he will also be considered as rotational director, not be considered as a non-rotational director. The last category is shadow directors, which legally is not a director, he is controlling the company in an indirect way. You know, there are a lot of scams which have come. I know the cook and driver of the director is also a director. He doesn't know. It's being controlled by somebody else. So they are called shadow directors. Yeah, this I've already told you, so I'm not going on this, but I'd like to tell you only two things: that independent directors shall not be counted for this calculation, and directors appointed by central government or finance minister of banks also will not be counted for the purpose of this calculation. Now, there's a new concept which is come, that is called concept of key managerial personnel. This is come with 2013 Act. Now it says that each of the persons to be key managerial personnel, the CEO or the MD or the manager. What does it mean? What do you mean by manager here? You will find that in the provision of Companies Act, some companies can have manager instead of managing director. And this manager is not like sales manager or marketing manager. This manager is a person who is having substantial affairs of management of the whole organization, whole company. The power which is equivalent to a managing director. So he'll be considered as a manager. Now, why this concept has come? This concept has come because of the garden companies, tea gardens. You know, British, lot of British people there. Even now, there are a lot of tea companies. Goodrich, Warranty, Goodrich, this, that, Lipton, Brook Bond. They're all British companies having tea gardens. So there was a post called manager, and this person was given substantial powers of management of the company. And this terminology or this position is continuing. So you will find very less. Manager in place of managing director is very less, but still there. I remember when Britannia was taken over by Bombay Dyeing. Britannia was taken over by the Bombay Dyeing. The managing director was removed, or I think he left, whatever. The chief operating officer was designated as manager and given the substantial power of management of the company. So he is one of the key managerial personnel. The CS is a key managerial personnel. The company secretary is a key managerial personnel here, and the chief financial officer, the whole-time director is also a key managerial personnel. And who else? Yeah. Who is supposed to have a key managerial personnel? Anybody having? Any company having a paid up capital of 10 crores or more shall have a full-time key managerial personnel, including a company secretary. So this is the concept of KMP, which all of us should know. We come to another term, the physical take-up after. Very important for all of you to know that committees are there, but before that, I'll try to tell you something about. Yeah. Now, there are 3-4 things which are important for all of you. The people is not here right now. That is, managerial remuneration. What should be the remuneration of the managerial personnel? That That means the directors. What it says that the total remuneration shall not be more than 11% of the net profit of the company. 11% overall. That means all directors taken together. But again, it says that the 75% of the shareholders agree. If 75% of the shareholders who are entitled to vote and they vote, then the commission can be more, their salary can be more than 11% of the net profit, which is a very high amount. Now it says that with approval of shareholders in general meeting, we can increase. But if you don't take approval of the company of the shareholders in general meeting, what will be the remuneration of managing director? It is 5% of the net profit. Either to managing director or to any other whole-time director or manager. 5% of the net profit. But supposing there are more directors, let us say there is one MD, one whole-time director, or one MD and 3 whole-time directors, then the remuneration payable to all the directors shall not exceed net 10% of the net profit. So is there any remuneration for non-executive directors, part-time directors? Yes. Remuneration for to any other director who are neither full-time director nor manager, managing director or manager shall not exceed 1%. So outside director can have all taken together, they can get a remuneration of 1% if there is a managing director in the company. But supposing there is no managing director in the company is being headed by a manager. In that case, these outside directors, they are called non-functional directors, they will get a remuneration of 3% of the net profit, which is a very high amount in case of big companies. Therefore, in some of the big companies, you'll find that the independent director gets nearly 1 crore. He gets 1 crore. Another catch, the sitting fee which a person gets for coming and sitting in the board meeting, that is excluded from this remuneration. Or he had made any expenses, reimbursement of any expenses, traveling, they will not be included in the expenditure. What is this in that case? This is only the commission which they may get. The outside directors will not get any salary. Full-time directors can get something as salary. The outside directors will get something as commission. They will get something as commission. So this is about managerial remuneration. So we need to know, after the constitution of the board, we need to know that appointment of returning director. I told you for the first time director, that's what I told you. Now, loss of office, when a director is appointed, he may lose his office. There is some disqualification under a particular act. Absent himself from all board meeting held during 12 months last, without seeking leave of absence, with or without seeking leave. Even when he takes leave of absence, he may be disqualified. He becomes disqualified by order of a court or a tribunal, convicted of offence involving moral turpitude, imprisoned for at least 6 months, can no more be a director. He fails to disclose his interest. A very important provision in the law which says that once you become a director, are you interested in this company? Are you interested in this company otherwise? That means, do you have any personal interest in the company? For any personal interest, you have to disclose your interest. But once you disclose, there is no problem. What will happen? Moment you disclose your interest, there will be somebody opposing that, or somebody saying, okay, so somebody says, okay, no problem. The majority of the people feel that yes, there is no problem. So there is no problem with you also. You are safe. But supposing if somebody says, yes, He is personally interested, so either he should not be a director or we should not go for that particular contract or particular arrangement where this person is interested. So this is the purpose of disclosure of interest. And as I told you, very important, this is only a illustrative list, this is not an exhaustive. There can be other things also. The question will come what the board is supposed to do. Board can make this thing. Or to make calls on shareholders in respect of money unpaid. To authorize buyback of shares. Buyback of shares is done with authorized on board. Issue securities, including debentures, shares and debentures. Borrow monies. Invest in the funds of the company. They can invest what they can do, grant loan, give guarantee or provide security in respect of loan, approve financial statement and board. This is only an exhaustive, approve amalgamation merger, make political contribution, appoint or remove KMPs, key manager person, appoint internal auditors and secretarial auditor, diversify the business. So these are some of the jobs which the board is supposed to do. But board has got certain limitation that I told you. Board cannot do everything. So let's see what the board is not supposed to do. Now this particular slide says that following power cannot be exercised by the board unless specifically authorized by the shareholders in a meeting through special resolution. So what are these terms? Now these terms are sell, lease or dispose of substantial part of business. It says directors are supposed to run the company as a going concern. Directors cannot come and say sell this business, sell that business. But still, director has the power to sell or dispose of part of the business, which should not exceed 20% of the net worth of the company, or it generates income up to 20% of the company. To that extent, they can sell or dispose of the part of business. If they are getting any money as a compensation on merger and amalgamation, they can only invest that money in trust security. Trust security means security is very trusted. Otherwise, they cannot invest within the power of the shareholder. Borrow money exceeding aggregated paid up capital and free reserves. In company, there is reserves all of the profit is transferred to PL, we balance it every year. That becomes the reserves of the company. Reserves is the liability and reserves belongs to the shareholders. Once you make the profit belongs to whom? Profit belongs to the shareholders. So what the shareholders need? Can they take the whole property, whole property to their profit to their home? Answer is no. So what they can take? They can take the dividend which will be decided by the board of directors. The company is making 100 rupees, they can decide, okay, 50 rupees can be given as a dividend and the balance 50 rupees will lie with the company, that will be the company only. Where this money will go? This money will go to reserves. The balance sheet, okay, transferred to from PL account it will be transferred to reserves. So this is called reserve. When you talk of reserve, there are again free reserves and specific reserve. Specific reserve is for a particular purpose. Let's say debenture redemption reserve. So the purpose of debenture redemption reserve is to repay the debentures. Repay the debenture. They'll create a fund and after maybe 5 years or 10 years, this fund will be given for repayment of the principal amount of the debentures. That's called specific reserve. All other reserve will be considered as free reserve. So what do you learn from this provision? That if the company is having 10 crores as share capital and 10 crores as free reserve, the directors cannot borrow more than 20 crores. Directors cannot borrow more than 20 crores in such case. So this is the power not available with the board. That means that if they are making a loan which is a larger loan, they have to take the permission of the shareholders because this is exposing the shareholders to liability. And next is give out time of repayment of loan recovery from directors. The loan is recovered from the directors. The directors cannot waive that time. That waiver can only be done by the shareholders. So this is the powers of the board, and let's see what is left out. We'll talk about here. I'm talking about women director has to be there in all listed companies, and in case of unlisted company of this size, that is 100 crores paid up capital or turnover of 300 crores. So, women director will be needed. Managing director is compulsory for all listed company, and for unlisted company, if there is 10 crores of capital that we've seen in the KMP list. And we need an independent director in all listed company. It says 1/3 of the total number of directors shall be independent. But if the chairman is full time, take the case of Wipro. Chairman is full time. Since the chairman is full time, the company should have 50% directors as independent directors. Now, unlisted company also need to have a independent director. Where the paid up capital is 10 crores and turnover 100 crores, aggregate outstanding is 50 crores. So this is the mandatory constitution of the board. So what you understand that the board has to have a combination of various types of directors. There's government director, there's independent director, there's a full-time director, there will be part-time non-independent director, there can be nominee director. So there can be various combinations of this director. And manager remuneration I've talked about, meetings of board. Yeah. So I'm not talking about committees here. Maybe some other committees portion will be there, but we'll talk it later on various committees through which the board is managed. So I'll just tell you here that how board manages a company. Board is supposed to manage a company through meetings. Now, what they do, they are supposed to meet. They are supposed to meet. The first meeting shall be within 30 days of the incorporation, and thereafter they will have meetings every year. And the gap between two meetings shall not be more than 120 days. So there can be quarterly meeting here, and the gap shall not be 120 days. So now the meeting is allowed through video conferencing also. That is a good thing which has happened. And a notice of 7 days has to be given so that the directors are prepared about the meeting. The provision was not there in the earlier act. The earlier act was very liberal, saying that the board can meet anytime. Board can meet anytime without giving any notice. But now the law says there will be a. Now, what happens in a board meeting? Very quickly, I'll tell you what happens in a board meeting. Is there is a chairman. Who chairs the board? It's called presiding over. Somebody presides over the meeting. There is normally the chairman of the company who presides over board meeting. He also presides in shareholders. But supposing that the regular chairman is not there, the directors present can appoint any other person to chair the meeting. You see the sequence. First, the board meeting is decided that this is the day we'll have a board meeting. Now, this is decided by the company secretary in consultation with the MD and the chairman. Moment it is moment it
কে
is
জানে বা একটা ম্যাডাম আছে ছেলের জন্য কিনেছে,
Sanjeev,
ছেলের
your
জন্য কিনেছে, ভেতরে কিছু
Sanjeev,
জিনিসটা রয়েছে, জিনিসগুলো
your voice is
গ্লোবাল
coming.
মতো, ভেতরে কিছু একটা পার্টস রয়েছে, ওটা
Hello?
পার্টস গুলো নড়তে শুরু করবে।
Hello?
মার্কেট থেকে
Sanjeev, your voice is coming. Please mute
Yes, sir.
yourself.
Yes, sir. Okay, okay.
So chairman of the board chairs the meeting, and as I said, if the regulation is not there, the directors appoint some other person to become the chairman for the meeting. The very important is quorum. Now, quorum is a very common thing. Most of you must be knowing about it. Any uh, meeting, there is a quorum. Even our parliament also has a quorum. Quorum is the minimum number of directors to be present to make the meeting valid. What happens if the quorum is not there? Quorum will be mentioned in the articles of association. Now, first of all, what is the quorum? Quorum is minimum number of, as per our Companies Act, the quorum should be one-third of the total number of directors or two directors, whichever is higher. Now, suppose there is only 3 directors in the company, so one-third will be 1, but the quorum will be 2, whichever is higher. But here, please keep in mind, articles can provide for more quorum. So, as per the Companies Act, this is the quorum. Articles can provide more quorum, that is written in your study mat, but let me make it clear also. Articles of association may provide for more quorum. If they provide for more quorum, there will be more quorum. Now, sometimes it so happen in a joint venture company, there is a veto given to the other party. That means, let us say there is a joint venture. Just for example, let's say Hero Honda. Here it says that meetings shall not be held if the directors nominated by Honda, at least one director is not present. Or meeting cannot be held unless at least one director from the Hero group is not present. So this is called veto quorum. This may be there in the agreement, it may not be there in the agreement. Now, agreement comes in the articles of association. JV agreement will come in the articles of association. This is called veto quorum. Now, how it happens? Each director has only one vote. The difference between shareholders meeting and board meeting is, in shareholders meeting, each shareholder has a voting right proportionate to his holding. Let us say I go with 100 shares and you go with 1000 shares. We will have 1000 votes, I'll have 100 votes. This is the concept of corporate democracy. Why there is a takeover and merger? Because more a person has more share, he has got more power. But that is not there in case of board meeting. In board meeting, everybody. We take the case of Reliance. When somebody is sitting in a board meeting and there is a voting, okay, somebody will have a single vote. But there can be provision in the articles of association that the chairman can have a casting vote. It is called second vote. The chairman is already voted as a shareholder, as a board member, and there is a tie. There are 10 directors in a company and 5 have said yes, 5 have said no. It doesn't happen in the normal course, but it do happen also. It happens mostly in case of 50-50 joint ventures. Or when the board of directors are vertically split. Vertically split means 5 this side and 5 that side. Whatever may be the reason. So 5 say yes and 5 say no. What happens here? The chairman will have a casting vote. Casting vote means he can have a second vote so that the tie is broken. Okay, so this is called casting vote. Interested directors shall not vote. I told you just now. I told you about interest of the directors, and all decisions shall be through simple majority. Simple majority. That means 50% plus. Leave of absence may be granted to a director. Now, what happens practically when you have a meeting? There is something called voluntary adjournment. Voluntary adjournment. That means we have to adjourn the meeting not because of quorum, but because of some other reason. There can be various reasons in a company doing that. There can be various reasons the company doing that. Board are not prepared. They're huge time taking. There are a lot of things to discuss. Certain particular person is not there. Some document or information is not there. So let us adjourn the meeting. We'll get the information tomorrow, day after tomorrow. We'll again sit. Now, adjournment is a word which means that any proceeding which is started but not concluded. Any proceeding which is started but not concluded, that is called adjournment. Okay. So what is an automatic adjournment? Automatic adjournment where the quorum is not there. It is called automatic adjournment. In automatic adjournment, what happens? Unless the company informs otherwise, please listen to me very carefully, all of you. Unless the company informs otherwise, the meeting will be postponed to the same venue, same day, same time, next week. But that normally doesn't happen because in the meantime, company will interfere and will give a notice saying that this board meeting was called, and because of this reason, this is adjourned. Now the adjourned board meeting will be held in this place. Okay. The next is deferment of for consideration. What does it mean? When you have a board meeting, maybe some of the items you are not discussing. Now there is a difference between adjournment and deferment. In adjournment, the whole meeting is shifted because you could not discuss some point. In deferment, what happens? The meeting is closed. The meeting is closed, and some of the items are not discussed at all. The board feels, the chairman feels that they are not important, so let us discuss in the next meeting. Just take up a very long business plan of the company, not very urgent. We can take up after 3 months. There is a business plan for coming 20 years, so not necessary you need to take today. So take out the item from the meeting, and this is called deferment. So what you do here, whenever the meeting comes, suppose the corporate plan for 2050, there is a document for corporate plan of the company 2050. What will be written? The minutes this item was referred to next meeting without any discussion. And you should know preponement and postponement. Preponement means you are advancing the date and time of the meeting, and postponement you are deferring the time of the meeting. Now we come to management of the board by committee. The first thing is why committees. Committee system is now only, it was not there 20 years before. Why the committee has come? Committee is a step toward corporate governance. Came because of corporate governance. It so happened long before in UK and USA that there are some corporate failures. Some company failed miserably and investor lost a lot of money. The question came why it was not detected. The directors are caught, they are taken into task. Most of the companies, the director said, see, we go to the board meeting and we sit in the meeting. We cannot keep a track on what is happening in the company. Can't have track. Only those people who are running the company on day-to-day basis, they know. We don't know everything. It is not possible for us to know. This was agreed by This then committee, there's a committee called Cadbury Committee long back, somewhere in 1958 in UK. And some more failures in India also have seen certain corporate failures. So they then decided initially that okay, if the whole board cannot go deep into the things, let a committee of the directors go deep into certain things. So the first committee which was suggested was audit committee. That means some of the directors, let us say there are 12 directors, and from 12 directors, 4 directors will have a committee and they will audit the performance of the company before the whole thing is coming to the board of directors, full board of directors. So with this, other important things are also identified. What are the other things? Nomination and remuneration. This committee will nominate who will be the next director of the company, who will be the next managing director of the company. So the next important thing was relationship with the shareholders. So a committee was suggested as stakeholder relationship committee. Now in the 2013 Act under section 135, corporate social responsibility was made mandatory. And it says that there will be a committee to oversee the CSR functions of a company. So there is another committee. Now the listed company says there has to be risk management committee because the company is doing a business and business is all about risk. So how the company is managing the risk. So this became very important for public companies because in public companies you are dealing with